Hello and welcome to your Daily 5. My name is Erin Swenlin with DecisionPoint.com, and I'm going to show you the 5 charts that I think you need to look at before you start this week. Well, it started off as a pretty interesting week. Last week, I have to say, we ended on a rather sour note. Things haven't been working out so well. But before I talk about that, let us talk about decisionpoint.com. You really need to come check us out. We have the DP alert, which is going to give you all of your market information, let you know what's going on with the general market, Bitcoin, gold, the dollar, yields, and much more. And then Decision Point Diamonds are going to help you pick out those stocks that will ride the tide of the trend and condition that we've already talked to you about in the DP alert. So if you want to try us out for 2 weeks, just use that coupon code at the bottom of this slide, DP Trial and the number 2. You'll get free 2 weeks to check us out. All right, we're going to start, of course, with the market. Let's look at the S&P 500, the SPY, and I have a daily 5-month chart that I look at every day in the Decision Point alert. We have been annotating rising trends, short-term rising trends for quite some time on the SPY. You can't see them all, but we've been running these through, and we finally got to this last rising trend line out of the March low, and that was finally compromised, but not compromised in a very serious way. It really mostly drifted out of this bearish rising wedge. I would say that it has been resolved with the downside breakout as is expected. It just wasn't, well, it was more of a drift, not a breakdown. So it takes a little of the sting away, if you will, from that pattern. We still have a lot of good things going on. We still have a positive RSI. We still have a VIX that is sitting above its moving average on our inverted scale. And I don't have stochastics on here, but they're not looking terrible. They're not looking great, but they're not looking terrible. So we're seeing some problems here in the short term. But what I really want to talk to you about is the intermediate term and how concerned I am about the intermediate term. So first of all, just notice that the PMO did turn down last week, and it is continuing down on today's start of the day decline. It's just starting to look a little bit weak. Well, a lot weak. This is the big problem for me. And I wrote a free article. I highly recommend you go check it out on my website. If you go to the blogs and links page on decisionpoint.com, you will see a free article that I named Heed This Warning. And I did that for a reason. I don't like what's going on. And if you know me, Erin Swenlin, you know that I tend to not be necessarily super bullish, but I tend to be a lot more bullish than my father, Carl Swenlin. And so I'm very bearish now. So that's, I don't know. Hopefully I'm right this time. Well, I don't know. Hopefully I'm wrong. But here's the problems. So the Swenlin Trading Oscillators have been, well, oscillating around very unhappily, and they have set up negative divergences. So we see lower lows, higher. We see the declining bottoms or tops. We see declining tops on the Swenlin Trading Oscillators, and that is leading into price tops that were rising. That means that we are looking at a negative divergence, and we should expect a reversal in trend here in the short term. This would be maybe okay, but the problem is that on Thursday, our IT indicators decided to top. That is a very bearish situation. As you can see, we've marked the tops in vertical red dotted lines and bottoms in green vertical lines. And you can see that right before these big drops on these tops, we will see the ITBM and the ITVM topping and moving lower. It is pretty much a given almost that this will happen. So the question is, how deep a decline will this be? Well, let's look at our next chart. This is our Golden Cross and Silver Cross Index charts. And this tells us the bias of the market. So I will tell you that while things look pretty terrible on that intermediate term chart, the bias chart doesn't look quite as bad. But the problem is it is starting to deteriorate. We need to see 50% or more stocks above their 20, 50, and 200-day EMAs. We have seen a lot higher readings than we have now. They are still above 50%. We have the Silver Cross Index still above 50% and the Golden Cross Index. Let me tell you a little bit about these. The Golden Cross Index measures how many stocks within the S&P in this case, how many stocks within the S&P have a 50-day EMA that is above the 200-day EMA. If they have that, they get counted in this index, and then we calculate the percentage. And just a tiny bit over half have a 50-day above the 200. We consider that meaning that there is a bullish bias. If the 50 is below the 200, that is a bearish bias in the long term, or a bear market configuration. Well, the SPY is still configured appropriately with the 50 above the 200, but we are seeing this deterioration under the hood on the participation of these indicators. The Silver Cross indicator is measuring how many stocks have a 20-day EMA above the 50-day EMA. So how many stocks within the whole S&P have that? And that is a little over 55%. So the numbers are still bullish. But that indicator chart on the last slide I showed you, I'm going to show it to you again. It's very important. This is really some bad news here. And you can even see some negative divergences here going on with those ITBM and ITVM. All right, enough of that bad news. Let's move on to looking at the strongest sector right now in the S&P. I believe it is consumer staples. And here is why. We have a very similar look to what we were just talking about on that bias chart, but notice the percentages above the 20, 50, and 200. We have well above 50%. We have over 80% above their 20 and 50. We have a Silver Cross Index that is on the rise, does look like it's flattening just a little. We have the Golden Cross, which is above its signal line as well. And you can see that participation is staying very steady. It's not really drifting off like we saw in the SPY. We have the PMO accelerating upward. It looks like we didn't have what I would call a PMO surge, which is a bottom above the signal line. We don't quite have that, but we definitely have a surge in participation as it accelerates higher. We have a nice breakout on a gap. I'd say consumer staples look pretty healthy here. And within consumer staples, I brought you a diamond of the week, and that would be Dollar General. Dollar General, I think, is set up beautifully right now, and it is breaking out. You have a reverse head and shoulders pattern. And if this pattern is fulfilled as this breakout from the neckline implies, we will get a move that could test these tops that we saw back in December. That would be a really nice upside move. And you can see, again, everything going its way. RSI positive, stochastic PMO is rising almost to positive territory. Stochastics are above 80. OBV is rising to confirm that the rally, and you can see that relative strength for the group and relative strength for Dollar General is starting to rise against the S&P. I think that this is a good diamond of the week. I will probably be presenting it to my diamond subscribers tonight, so definitely take a peek at it. That is all I have for your Daily 5. Thank you so much for watching. Do come and check out decisionpoint.com. And for now, I will wish you all good luck and good trading.